Stocks have had a strong performance in the first half of the year, but some pundits claim that it's only a small handful of those big tech names driving the rally. Well, our guest today says if you look under the hood, there's actually more strength to be found. Joining us now, Ben Gossack, Portfolio Manager with TD Asset Management. Ben, great to have you back on the show.
Thanks for having me back.
All right, so you'll see a lot of it out there. People who follow different finance blogs or watch different programs will say, "Oh, sure, you've seen a rally in the S&P 500 so far this year. It's 7 names and no more." What do you make of that theory?
Yeah, look, there was a strong narrative exiting last year, beginning of this year. Earnings expectations were too high. The economy was going to slow. Therefore, equities were going to underperform. And so we've seen actually equities outperform. And I think people have just rationalized that to looking at the market cap weighted indices and saying that this rally that we've been experiencing is only driven by 7 stocks. And we have yet to see this recession. And so it's, yes, things have moved, but if it's only 7, it can be dismissive. I think we're an industry that's obsessed with the sun. We care about solar events, especially rotations around the sun. And so when you look at the market, for many of the stocks, especially the biggest weighted stocks, they made bottoms at the end of last year. And so
just happened to happily coincide with the calendar year.
Exactly. And so let's say a stock falls 50%. Just to get back to flat, it has to rally 100%. And if that happens, that counting happens to happen around Jan 1st, well then yeah, if the stock is up 30, 40%, again, it still hasn't even made the prior high, you'd say, wow, that's a strong start to the year. And so I'm seeing a lot of these bar charts where, again, the NASDAQ has never made this quite of a strong start to the year. It negates the fact that you couldn't own these stocks last year and that they closed at their lows in terms of their prices.
Okay, so let's start breaking it down. You always bring the charts. Always appreciate that. It's a great way to take a look at the market. So we're talking about 7 names. We know the big culprits. You're going to start breaking them down in little groups. So this one we have Apple, Microsoft, and NVIDIA. What's this chart telling us?
So, Greg, what I really wanted to do was put 7 stocks on the same chart, and then I realized it was a bit of spaghetti.
It's too much information.
Okay, so I broke it up into 2 cohorts. So we're going to focus on the 7 stocks that everyone's talking about, but I broke it into 2 parts. So we're looking at Apple, Microsoft, and NVIDIA. And there's narratives about AI, but let's just ignore that. Let's look at the prices. And you can see that all of last year, these stocks underperformed. In many cases, in the case of NVIDIA, down 40 to 50%. They made their lows at the end of last year. And so they're making their rallies now. NVIDIA has exceeded its prior peak. But again, if it's down 50%, it has to rally 100% just for you to be flat. I expect most people that are watching us right now own these stocks in their portfolios, and therefore you're not really up 100% or 50%, you're flat. So you've just made your money back, and now the real harder work happens in terms of making new highs. So that would be in cohort 1 is just Apple, Microsoft, NVIDIA. Yes, they've rallied a lot this year, but as a shareholder, and especially a long-term shareholder, you're even Steven.
Let's get to the second cohort then. I think we have Meta, Tesla, Amazon, and Alphabet in this chart.
Right. So again, everyone's talking about these companies making these massive moves. How can they keep going higher? And so again, all of these stocks made their lows in terms of their prices and at the end of December. They're rallying. But you can see with this cohort, there's still so much more to go before they even hit their prior peaks. And so again, fundamentals will drive whether, in some cases, some companies have changed business models. So Netflix with subscription, putting in some ads, there's some rationalization why that might be better. We know Meta was going after the metaverse, and now it's about cutting costs, same with Amazon. But just because these stocks have gone up 30, 40% from their lows, doesn't mean that there isn't more to go. So I just wanted to make sure, again, this is a feature of the fact that we rotate around the sun, and that's when these stocks made their bottoms. And just because they're up 30, 40, 50%, as a shareholder, you might still be underwater, especially for these last 4 stocks.
As we continue to take a look at this narrative about only 7 stocks driving what we've seen so far, based on the solar calendar, of course, that would suggest that only 7 stocks have been making advances. You also have a chart showing us the S&P 500, the advanced decline line, and what's this telling us?
Right, and I've come on the show before many times, again, talking about the trends underneath the surface of the market. My thesis is that the market made a bottom last year, the market of stocks. And I think if you focus on market cap and large cap companies, you lose track of the broader market, and there's lots of stocks out in the market. What we're looking at now is this, it's a market breadth indicator. We're looking at accumulation less decumulation. So if there's 500 stocks in the S&P 500, if the stock closes up for the day, that's a +1. And if it closes down, that's a -1. And so if there's 490 stocks up and 10 stocks down, like that's how we make our math, and we count it every day. And so it depends on your starting point. Clearly last year we were in a downtrend, and so the decumulation picked up. But ever since the October low, I mean, if it was only 7 stocks, we wouldn't be making an advance in this line. And so every day there are more stocks that are up than stocks that are down, and this trend has continued to this day since October of last year. So again, it's more than 7 stocks. It's just these large market cap stocks are obscuring. And also, I think there are a lot of people that sat on the sidelines, and it helps to rationalize and say, hey, I didn't miss out. I'm not wrong. It's just 7 stocks. But again, there's way more participation happening in the market, given that, again, our belief is that stocks did bottom last year.
Now, I think if we went back to shows from last fall, maybe even late last summer, you would have been on here showing us home builder charts and seeing some pickup there. I think lately there's been sort of a broader conversation around the home builders finally starting to pick up. So I think you wanted to show this in terms of when that pickup actually may have began.
Right, so we've found it's been helpful to look at this market on a relative strength basis versus looking at sort of absolute levels. It's only recently that I'm hearing a lot of chatter about home builders. Isn't it odd that home builder stocks seem to be doing well in an environment where mortgage rates are high? We've seen what has happened to activity, but we marked the bottom for home builders to be March of last year. And what was most notable to us and surprising to us, in fact, counterintuitive, and the definition of contrarian, is that the home builders, which would be the most sensitive to interest rates, bottomed when the Federal Reserve began their unprecedented hiking move. Now, does that mean the people that bought home builders ignored the Fed? I would show people that chart and say, like, start earlier. They started to underperform in October and November of 2021 and lost a lot of value between October of 21, March of 2022. So the market, in its wisdom, took out the value, punished these stocks, and by the time we got to March, had priced in the fact that new home sales would be down, existing home sales would be down, purchasing, all that type of activity would be factored in. The part that I appreciate more and more is just how far stocks can price in bad news. Sometimes we're led to believe it's 6 to 9 months. In the case of home builders, it's been over a year that they were able to price in the bad news.